Welcome to Friday Live. Friday, the partners of HBK Providence get together to discuss what's going on in the latest trends in the markets and the economy, and we tie in some different financial planning topics. So today we have partner Brian Peluso. Brian, glad to have you here.
Always a pleasure.
We were all on last week.
Yeah, we had the whole crew, all three of us, three partners in HBK Providence, two in Florida, one in Western PA.
Spooky Halloween themed episode.
Yeah, exactly.
So, I mean, despite the lack of the major economic data, we still have a lot coming through. We'll get to that. We'll get to the markets. But first, we want to talk about something we're pretty excited about. We've been doing the daily blog posts, and they've been kind of thematic, but not formalized. So we got something definitive here now. So, Brian, you want to talk about it, or you want me to?
No, I'd be glad to. So, of course, on Friday Live, for those of us, those of you who have joined us in the past, what we do on Fridays, 12:30 p.m. Eastern Standard Time on Facebook, is we talk about, expand on some of the social media posts. Historically, Mike puts out a week ahead on Mondays, and then we kind of mix in different financial planning or economic posts throughout the week. But now we're going to be more thematic. And as you can see here on the screen, on Mondays, we're going to have Market Monday. We're going to do Tax Tuesday. Now, it's very important to note that we don't give tax or legal advice. We don't prepare taxes at our firm. But certainly a lot of the things that we do involve the tax code. So on Tuesdays, we're going to put out some information about how investing, how financial planning dovetails with taxes. And we just finished up our client survey, our annual client survey. And I would say the most consistent proactive feedback that we got is, hey, I'd like to learn more about how my investments affect my overall tax picture. So that's going to be on Tuesday. So Tuesday, social media posts will be Tax Tuesday. Wealth Building Wednesday, those are going to be more conceptual financial planning topics. And we talk about those throughout our posts. But on Wednesdays, that's going to be more about the major areas of financial planning, to include cash flow, protection strategies, insurance, investment management, the retirement planning, tax planning, and estate planning, all of those areas, but more importantly, how they all fit together. So that's going to be Wealth Building Wednesday. And then Think Ahead Thursday is going to be about proactive future planning. What are the things that I can do now, regardless of how the world looks to me at this moment? What are the things that I need to be doing now to prepare myself, my family, for the future? So that is what you can expect to see from us each week. Generally the topics, and then we'll tie it all together on Fridays, and hopefully anything that wasn't clear to you, that will help to make more sense of it on Fridays. Friday live, 12:30 p.m. Eastern Standard Time on Facebook. Sorry,
Brian, you might be a little biased, but if you had to pick one as your favorite daily blog post, which day would you pick?
Yeah, that's an interesting question. I think well, let me answer it this way. I think the Tax Tuesday is what many people will look forward to the most. My personal favorite is the Wealth Building Wednesday. Mike, I don't even think I need to ask you what your favorite is going to be to put together.
To put together for sure, Market Monday. Since that's my content and I don't obviously learn from it, I would say my favorite to read is probably, I love your financial planning posts that you do on Wednesdays. So I'm going to have to pick that one. And then I always enjoy doing Friday Live with you.
Yeah, absolutely. Well, I will say, which one do I personally look forward to the most? And it's, I guess it depends on the time of year and what's going on. I will tell you at this moment, for reasons that we'll talk about, and then Mike will have you do some of your commentary on what's going on in the market. At this moment, I would say I look forward to talking to you and reading about the market. That's the one topic of all the things that we do that I'm starting to hear more and more about. So why don't you jump right into what's going on now, and then we'll kind of talk about what's going on now and how people should think about some of the data and the figures that you're going to talk about, and some of the things we might be able to help them with.
Yeah, absolutely. So as I mentioned before, we're still in kind of that data vacuum. We're relying more on the secondary data instead of like the Bureau of Economic Labor Statistics, like the non-farm payrolls that we should have got today, which we didn't again for I think the second straight month. So that's a shame. And it looks like that's going to continue. We're at a new record for longest shutdown. Not that that's a title that should be praised or awarded, but we are, I think, at 36 or 30.
I think it's
37. 36 or 37 days now of the government shutdown. The previous record was 35 days. And if I think anything we learned from the elections on, was that Tuesday?
Yeah, Tuesday.
The Democratic parties really had some big wins. So it seems that they've gotten some leverage back. And I think a lot of the blame's now being put on Republicans for the shutdown. So they're not as eager now to kind of move to the table and negotiate. So I think the latest is President Trump's trying to push the Republicans to do away with the filibuster.
Oh, yeah.
So I think if that can come, maybe we can get an end to this soon. But I mean, we've been seeing big disruptions. I wouldn't want to travel right now. Airlines have been a mess. I feel bad for those workers that haven't gotten paid for 3 weeks. They will get paid eventually, but I mean, eventually it's tough for them to spend money on their families, and that's ultimately going to factor into economic growth and spending, and maybe put a little hiccup in this economic growth story we've had.
Well, let's hope not. It's kind of gotten long and painful for sure. Tuesday was interesting. My sense, this is my personal sense. I'm not a political commentator. This is my observation. I think Tuesday people were voting against something more than they were voting for someone. It's my personal opinion.
So we did get some economic data this week. We had the ISM numbers. So on the manufacturing side, it continues to be weak, remain in contractionary territory, which is below that 50 level. So I think we were 48 and change. That was lower than the previous month and estimates, but some bright spots in that. New orders was a nice uptick. So that should be good for going forward, the next reading we get. And the employment situation still looks pretty good, which was consistent with the ISM services, which was pretty much a strong report on all levels. The headline rebounded to 52 and change, which is a nice uptick, getting away from that kind of contraction expansionary line. New orders was also strong. And like I mentioned, the employment situation. So that's a good thing. We got some labor statistics, as I mentioned, not the one we usually look at, the first Friday of the month, not farm payrolls, but we got the ADP numbers, which are actually reporting on a weekly basis now, which is kind of cool, just to give markets a little more insight. So leading up to this report, we had 2 negative monthly readings of job growth. So a reduction in the hiring. This one was a nice uptick to, I think, 42,000. So that's a good thing. On the not so good front in the labor market, we got the Challenger Jobs Report, which is a calculation of both public and private announced layoffs. So that number was 150,000 layoffs or job cuts. That is the highest reading in 2 decades.
Oh, okay.
Yeah. I think that deserves a boo.
I agree.
So, I mean, there's a lot of mixed readings out there. There's a lot of uncertainty. We have the government continuing to be shut down. The economic data is mixed. It seems like labor market's at least stalling out, if not going to start to flip negative. Tariffs are another potential uncertainty. We don't really know what's going to happen with them. At the same time, earnings growth is actually really strong. I think we're tracking 14% for the quarter. But what I've seen of late is the beats aren't really getting rewarded as much. And there's been some big, massive drawdowns in some stocks. So I think the market's getting a little more wary. And that's pretty normal for a market that's, I mean, we're up 35%. Let me pull up the chart. We're up 35% from the April lows. It's just been straight up minor pullbacks. dip buyers have been pretty eager to get in. This week, we're actually having the biggest pullback we've had in a while. I think we're down about 3% right now. We just violated the 50-day. We'll see if we close below that. There's a ton of support below this, though. We have the early October lows of, let's see here. I got to look at my actual screen because it's a little tiny on here. So that's around 64 or about 65, 50. And then below that, we have the 100-day, about 64.50. So plenty of support levels. I mean, it's no secret. I've been talking about, I think we need a correction for a while. We'll see at what point buyers really step back in. But some charts I want to bring up. I mentioned when markets become a little more vulnerable when we're trading at such high valuations. The overall market's trading at 22.8 times forward earnings. Now, I always discuss that valuations aren't a good timing mechanism. But in the long term, they do matter. And that's really being driven by the top 10 stocks, which is close to 30 times forward earnings. The remaining's not as bad, but it's still overvalued. This is the chart I really want to look at to the right. The weight of the top 10 companies in the S&P 500 is now over 40%. So it's becoming more and more concentrated every year. That's a little alarming to me. And you look at, based on a market cap weighted, we're at 19.4 trillion for the top 10 companies. Look how that compares to the previous decades. Like, it's just insane. Like, we have $5 trillion companies now. That's small. That's more than countries. Any thoughts on that, Brian?
Yeah, is that sustainable? So you got 40%. So Mike, when you say 40% of the S&P 500, this isn't exact math, but so essentially, is it fair to say, kind of 40% of the upside of the market, the S&P 500, if you call that the market, we will for this purpose at this moment. 40% of those returns come from 10 companies, effectively.
Mm-hmm. And on the flip side, let me pull up that chart again. 32.5% of the earnings come from those top 10 companies. So
yeah, right.
They are making a bulk of the earnings, but they are outpacing that with their weight in the S&P 500. Yeah. And I mean, it's really, like, people always talk about the S&P 500, the market cap weighted, and that's what we tend to follow as an index, but that doesn't necessarily mean that's what's going on with the bulk of companies. We've seen a ton of companies with 10, 20% pullbacks in this uptrend. Breadth has been terrible. Even if you compare the market cap weight to the equal weight, going into this latest 3% drawdown, I think the market cap weight was up around 17%, while the equal weight was up around 8. I think closer to 9, maybe. So we've seen this over the past couple of years. It's been a big dispergence between those top 10 companies and the rest of the market, but you got to play with the hand you got, right, Brian?
Yeah, well, yeah, for sure. Yeah, hey, sunflowers don't grow to the sun. Mike, would you say you alluded to it? Would you welcome a little bit of a pullback, a little bit of a correction?
I would. I mean, I think it's healthy for a sustainable bull market, and we've been raising some cash over the last, call it month and a half. And we might, depending on the technicals, we might raise a little bit more, but more so in the retirement accounts. We don't want to make big tax implications for the non-retirement accounts. We have some stocks with some big embedded gains at this point. So I think the stories are still intact long-term on a lot of those, but I don't think it's worth realizing substantial gains in the short term to add to their tax consequences, because we're starting to be more tax focused with our blogs, and it's all about after-tax returns in those taxable accounts. And that's what people really care about.
Yeah. I mean, we can certainly be tax aware for sure. And we are as much as we possibly can. Of course, somebody's overall tax situation involves much more than just their investment accounts. So we got to, be conscious of that as well. Let me ask you this question, Mike. So we get kind of mixed data right? Unemployment, earnings are okay. Unemployment's kind of mixed, some good, some bad. I would say probably the same with housing. Right, people keep buying houses at higher and higher prices. Mostly bad. Okay, we'll go with mostly bad on that. Hey, here's the question that is posed to me, and let's contemplate that for a minute. So, and you look at a ton of different things, and thank you on behalf of myself and our clients. What are the chances? Well, what would be the chances that you look at all these things, but then one day you wake up and in a big surprise, they're all negative? Or are all of these pieces, are they things that start to tell you a story over time and you can begin to, begin to make adjustments that are necessary? So, is it possible? I think that's what, if we take this conversation that we're having now and all these individual components, I'm going to paraphrase the questions I'm getting in our financial planning discussions. What are the possibilities that one day you wake up and say, oh my gosh, overnight, these are all super negative and boom, it happens. And the market just goes down. What?
I would say it's probably higher than people think, just because most recessions have some kind of exogenous shock that goes on, and usually it's revolved around credit or leverage. So usually something blows up. So in those circumstances, the economic data kind of follows that. So it's tough to anticipate. But sometimes you see the weakening of the labor market. You see spending slowing. You look at some of the leading indicators like claims when the government's open and that data is available. But I think it's just being a prudent portfolio manager. You need to, when we've had such a good run, no need to be greedy. Potentially take some profits off the table. Make sure you're positioned and are comfortable with your portfolio allocation, because drawdowns will occur. We will get a 10% correction at some point. We will get a 20% bear market at some point again. We will get a recession at some point. So make sure you're positioned for that. Don't get alarmed. Don't go all cash. That's certainly not what we're saying. But incrementally get a little more defensive as things are going robust and no problems seem to be an issue for the markets. And that's kind of the way we manage portfolios. We try to be very tactical, but it's very tough to time the exact top or bottom in a market. So we try to do that gradually. Yeah, it is impossible.
Yeah. So that ties in with the financial planning. So what do you do from a financial planning standpoint? Review the plan. Make sure you have good cash reserve. That's always market way up, market way down. Make sure you have good cash reserve. Diversification is paramount. What is diversification? Simply said, you have a bunch of things that do different things at different times. Some will be up, some will be down. But over time, you're trying to smooth out that ride and, kind of go on the escalator slowly upward over time. That's not every moment. That's over time. So always have a good personal reserve. Always be mindful of diversification, that pieces of your portfolio, especially the longer term portfolios, have some things that will go up in different markets and then go down in different markets. And that's okay. That's what diversification is all about. Make sure you have appropriate timeframes for each pot of your money in your financial plan. I say this all the time. If somebody comes to us and says, hey, I might need this money in a year, it's not sitting in the stock market. So be very, very clear and honest with yourself. Say, hey, these are my goals as I know them right now. I want to have a 35-year retirement. I want to buy a piece of property a year from now. I want to buy a new car probably, I'm guessing, 3 years from now. And work with us to make sure that you have those goals. Of course, a financial plan is like any other plan. It's very dynamic. It's a living document. It changes on a regular basis. But those longer term goals, make sure you have your pots of money, your personal reserve, your short term money, your medium term money. Let's call that 3 to 10 years. Medium term and then your long term money. In doing that, when the market does have its corrections or its fits or that exogenous event that nobody can predict does appear and does affect all of these things, that you could sit back and say, hey, do I need to adjust my plan? Have my personal goals changed? and let's work with my financial professionals to make any adjustments, because it would be adjustments at that point, and that's what you kind of want to look for, not a major overhaul. Holy heck, the market's been going straight up, now it's going straight down, I got to change everything. You don't really want to be in that position. That would be at the detriment of your current and future self. So that's where the financial planning fits in.
Brian, we're potentially in the start, not for sure, of a pullback of some extent. And we've had pullbacks in the past. If you would have to pick a client mix of ours based on what type of assets they have that don't get as concerned as the person that's all in the market, what would you say? What segment is that? Is there a certain product that they have, or asset class?
No, it's the folks that we have worked with and are willing to work with us most closely to identify their goals, manage their goals. I would say folks that have a higher percentage of what I call assured sources of income. That would be Social Security. And, most people don't think of that as assured. I'm very comfortable that Social Security is going to keep sending things out, but there's a little uncomfortable about that. Certainly the folks that have pensions, which we see less and less of, and they just don't exist for as many people as they used to decades ago. And then for people that it fits into their financial plan, that they have a short source of income from, possibly an insurance product, an annuity, cash value life insurance, which isn't as assured. But the folks that, as a general category, if I could narrow it down, it's the people that live off a higher percentage of assured sources of income, where they can sit back and say, it doesn't matter as much to me what my portfolio does, because I know next month, this is what's coming into my household. That's my personal observation in working with our clients during downturns, and the people that are the first to call and say, oh my gosh, the world is ending. And the people that say, hey, it's okay, things go up and go down. The people that say, it's okay, things go up and go down, and I've been through this before, are usually the ones that have a higher percentage of their monthly income that is assured.
That makes sense.
And there are ways to do that above and beyond just Social Security and pension, if it's appropriate, if it fits into the planning, if it fits into the tax picture, and so on and so forth. So
as we're coming to year end, any advice for people regarding taxes or what they need to do before year end?
Yeah, absolutely. We've been working with a lot of folks to make sure, depending on their age, if you have retirement accounts and you have required minimum distributions, that could be from a beneficiary IRA that you received from somebody. That could be if you are in the old rules, 70 and a half, and you're older now, and you've had a required minimum distribution since 70 and a half. Most folks now it's 73. It's going up to the age of 75. We covered that on a couple different Friday Lives. So, make sure you're getting your RMDs done. Those got to be out. These have to be. How about that for an articulate? They got to be out. Those need to be out of those accounts by the end of the year. For the most part, there's some other, but just think of it as the end of the year.
Any advice for those people that don't want to pay taxes on the full amount?
There are ways to do that. We work with a lot of folks that do what's called a qualified charitable distribution. So you can take money out of your IRA and send it directly to a charity. So for investors that the RMD, the required minimum distribution out of a retirement account, is just a hassle, like, geez, I don't really need the money. And it's just a way for the IRS to get into my pocket. There is a way to take money directly from an IRA. It has to come directly from an IRA, cannot be something you receive in hand and then send it to a charity. So it's got to come directly from the IRA. It does help to satisfy the required minimum distribution amount, and it goes directly out of your IRA to the charity tax-free. So think about if you are regularly contributing to a charity from money that's already been taxed, sitting in your checking account, and you are contributing to them anyway. And if you're somebody that has a required minimum distribution, There's a caveat on this. You can actually do the qualified charitable distribution if you're 70 and a half and older, even if you haven't reached that required minimum distribution age. But in any case, if you're thinking, geez, I'm getting all this taxable money, I don't really need it for really my financial plan has worked out, it's just a hassle to me. I'm giving money to a charity anyway. You might want to consider taking money out of the IRA and send it directly to that charity. It's called a qualified charitable distribution. You can do that if you're 70 and a half or older, even if you haven't reached the required minimum distribution age for your birth year, but 70 and a half and older. And this year, I believe you can send a maximum of $108,000 to charities. So you can go above and beyond just the required minimum distribution, but whatever you are sending does count for required minimum distribution. I personally love that strategy. It's not for everybody. If you're taking a regular distribution out of your IRA to pay, or your retirement account, to pay for living expenses and just keep the lights on and food on the table, then keep doing that. But if you're somebody that says, geez, I don't really need this and I give to charity anyway, that's something to consider.
Okay. All right. And then we do have, David will be hosting a webinar next week in Sarasota. So if you haven't registered yet for that, you can go to our website, go to resources, and then the events tab. It's going to be at Cooper Hawk. It's going to be a happy hour specific for women building financial independence. So he has some guest speakers in that. Should be pretty informave. And then Brian,
now, Mike, you mentioned webinar, but that's actually an in-person event. Sorry. Yeah. So seminar, it'll come webinar, seminar.
And then next month we're going to be doing a webinar, not seminar.
Exactly.
A presentation about taxes. Brian, you want to talk about that a little bit? It's about the different tax strategies you can do at different stages in your life.
Yeah, you've got, we can really simplify these things. And we really pride ourselves on taking what many people try to make very complicated and simplifying them. And so if you kind of think about different phases of your life, you have an accumulation phase. This is where you're saving a lot, hopefully saving for your future. I always talk about that kind of short-term sacrifice, long-term gain concept. Short-term sacrifice in the accumulation phase is you don't spend the money today. The long-term gain is that you're kind of negotiating with your future self. Say, if I save this today, my future self has more money to live the way they want to live into the future. So you have your accumulation phase. You've got a distribution phase. This is all these things that you've collected. And now that is how, and it's easiest to think about in terms of work. As you're working, you're using your intellectual and human capital to fund your life because you're working, and your expertise, your intellectual expertise, your physical abilities get you a paycheck. But you're going to transition to a point in your life where your intellectual and your physical and your professional capital decreases just in time. And that's just the way life works. And what you're going to be using is your accumulated capital, your accounts, IRAs, 401ks, 403bs, 457s, that kind of thing. That becomes the capital that you use to fund your lifestyle. So you got accumulation phase, you've got distribution phase, and then you've got a phase that when you're not here, where do all of these things go? That's something that you contemplate during your accumulation and your payout phase. Each of those phases have different tax considerations. Where do I put money that I can save on taxes now that I might have to pay taxes later? Where do I want to put money that I pay taxes on now, but maybe never have to pay taxes on that again? And where do I put money that's taxed along the way, but is super flexible to me? So there are, with each of those phases, there's different tax considerations. And it's really is where the financial planning is coming to narrow down specific amounts and specific action steps for each of those phases. But that webinar is going to talk about, in general, considerations for each of those. And, again, You look at retirement plans, and it often comes down to when do you pay the taxes? Pay it now and not pay it again. Don't pay the taxes. Get a little bit of break on my taxes now, but pay taxes later. And so that webinar is going to talk about all of those concepts and those considerations, regardless of whether you're in accumulation distribution phase or if you're looking at the phase of your life where you are going to pass money along to others while you're here or while you're gone. So,
except for HSAs, you may never have to pay taxes on that.
I love the HSA.
Tax deferral, you get tax withdrawal free.
I mean, it is really, it is absolutely a wonderful account. I think, I haven't read every line of the tax code, but it has to be one of the most advantageous accounts available in the tax code. That's true. There are these little exceptions out there, and if it fits into a financial plan, certainly something to consider. I happen to love the HSA. Again, personal, professional observation, but
so Brian, any big plans this weekend?
No big plans this weekend. I'm going to go watch the University of Pittsburgh play hockey tonight and tomorrow. And that's about it. Winter is coming to Pittsburgh. They're talking about a little bit of a possible overnight snow flurries over the weekend, which I love. 35 degrees this morning. Go out, take a little walk. The sun is beautiful. So I'm all for it.
I think we're getting down to 40 on Tuesday in North Florida.
I love it.
Don't worry, I'm preparing. I called the gas company. I'm getting the propane tank filled. Gonna get that fireplace going.
Well, that sounds wonderful. How about you, Mike, newly married man? What's what are the newlyweds? What are their plans shortly after?
I think we're gonna take it easy tonight, and we're gonna, I think, babysit Corinne's niece and nephew tomorrow. As they were both in the wedding, and the niece got her wedding present already, but the ring bearer hasn't gotten his yet. We promised him a new Lego set. So I think we're taking him to the Lego store, and then we're going to have them both come over and play with my old Hess trucks and that kind of thing.
Yeah, it sounds like you or somebody in your life is trying to prepare you for your future. So, so that's about it. Hey, let's close out. We got important disclosures coming up. Hope you found this to be helpful. Again, we're going to have Market Monday, Tax Tuesday, Wealth Planning Wednesday, and Think Ahead Thursday. So take a look at those, quick glance. If you prefer just to get the Cliff Notes and prefer to hear us talk about it, we do that Fridays, 12:30 p.m. Eastern Standard Time on Facebook.
And then Tuesday, I believe, is Veterans Day. So stock market will be open. Bond market, I believe, is closed. But we just like to thank all the veterans out there. We really appreciate your service and you putting your lives on the line for our country.
Yeah, it's an incredible amount of sacrifice, not only for those folks that are in combat zones, but for all the folks that have spent time in the service. It is an incredible time sacrifice. There's a lot of pressure that goes on the families of those folks. And, for me, Memorial Day, 4th of July, and Veterans Day are my three favorite days to just kind of sit around and be thankful for a lot of folks. And so I certainly plan to do that. Whether the market's open, the stores are open or not, I will be thoughtful and thankful.
Yeah. All right. Well, everyone have a good weekend. I'm going to flip on the disclosures, and then we will see you next Friday at 12:30 Eastern Time.
Securities offered through LPL Financial, LLC, member FINRA, and SIPC.org. Advisory services offered through LPL Financial, LLC, a registered investment advisor. Brian Peluso, Michael Kutch, and David Harper are registered representatives of LPL Financial, LLC. Content discussed is for informational purposes only and not intended as an offer or solicitation to buy or sell any security or investment strategy. Any opinions expressed are those of the authors and do not necessarily reflect the views of LPL Financial or its affiliates. All investments involve risk, including the possible loss of principal. This communication may include links or references to third-party websites. These links are provided as a convenience only. LPL Financial and its representatives are not responsible for the accuracy or content of such sites. Brian, Mike, and David and HBK Provident Advisors may only transact business in states where they are properly registered or exempt from registration. Please contact us directly for information regarding licensing and registration status.